Welcome back to another edition of Financial Accounting. One of my favorite topics is the time value of money. It tends to be a favorite topic, of course, for the finance majors because time value of money underlines pretty much all finance theory. Real quick, this is where we stand. So a week from today, we're going to have a review for our exam, which is on Friday, April 16th. So just realize this is a quick turnaround. Most of the questions on this exam, for exam 5, are going to be from chapter 9, about 16 questions. Another 5 questions from appendix F. So appendix F is important to go through because a lot of the calculations that we do for chapter 9 are based off of your knowledge of time value of money concept. So make sure that you're aware of what's coming up. On my accounting lab, there is the extra credit project due on April 20th. Make sure you start plugging away at that. Let me know if you have questions. We will talk about this little table calculators I put up on Appendix F here as we go through this lecture. Appendix F, time value of money, what is it? Essentially, it's this notion that money generates more money over time. So we have $1,000, we invest it over time, it's going to grow to some other larger amount. Okay, it's going to get bigger over time. And the notion behind this is sort of the underlying theory behind this sort of harkens to the economic theory or concept of opportunity cost. That is, if we forego consuming cash today, what could we possibly do with that money instead of consuming it? We could invest it. And if we invest it, it'll generate a return of some amount, therefore making it bigger. So all of this stuff is simply to say that time value of money, the amount of money grows over time. Another way of looking at this is also in terms of the purchasing power of a dollar. So what used to cost $1 yesterday potentially costs like $1.10 in the future, right? And the reason why is because we all know of inflation, right? It takes more amounts of money to buy the same good or service. So we can look at that and say that it's not really that the quality is getting better of these goods and services. It's just that the value, the purchasing power of a dollar decreases over time. So time value of money sort of harkens to both those things. Maybe an erosion of the purchasing power, or this notion that if we invest in our money rather than consume it, it's going to grow over time. Time value of money, time is money. The amount that I invest will grow over time. In the case of these chapters, we're going to focus on the change in the value being driven by an interest rate. Now, interest, we know, is the cost of using or renting money. Chapter 9, we are the borrowers in Chapter 9. We're going to borrow money, and interest is the amount that we're going to incur. So there's some terms we need to be aware of when it comes to doing present value, future value, for any time value of money calculations. The present value, PV, is figuring out what is the value of a dollar today in today's money or today's value to us. Future value is how much that dollar is worth sometime 1 year, 2 year, 20 years in the future. So present values today, future values in the future. Why does that really matter? Well, generally speaking, what I do is I tell students that you have to sort of imagine yourself as an investor. I know, for instance, sometime in the future, how much cash I need for retirement, but I don't know how much to invest today. I may need to calculate a present value given a certain known amount in the future. That's how I determine the present value of a dollar today, is I figure out what I know in the future and I discount that backwards. Or maybe I know how much money I can invest today, but I want to know how much it's going to grow to by the time it reaches the future. Well, in that case, I'm doing a future value calculation. I want to know what an amount's going to be if it grows a certain percentage of interest over time. And we'll go through these concepts, of course, in examples. So imagine that we're trying to determine a future value. What is the value tomorrow of an amount invested today? Well, let's assume that we have $4,500, $45. And we believe if we invest it into some type of mutual fund or exchange traded funds, ETFs, or some type of index fund, we can generate a 10% return over the next year. What's the value what's the future value in this case? I know the present value. I don't know the future value. I can perform a future value calculation simply by multiplying the $4,500 I invest today times 1 plus the interest rate to get the future value. That 1 plus the 1.10 is essentially saying that, look, the interest is the 10%, but I'm going to have my original investment, the 4,500. I'll just have that 4,500 times 1 plus another 10% of that in the future. So this 5,000 future value is essentially saying that, look, that money has grown, and it's grown because of what? Because of some sort of interest or return on this investment. So I don't know the future value, but I want to know what it is. I have a present value in mind. That's the calculation on how I determine one period in the future how much my investment will become. The difference being, of course, the interest. $455 of interest is what I earned. That's one way of using time value of money concepts. An amount today, figure out how much it's going to grow to the future. But what if I'm planning on retirement and I know what the future target amount is? I just don't know how much to invest today. Now we're talking about present value calculations, and this is the basis for Chapter 9. So it's important that we have a solid understanding of how present value works. What's the value today of that amount I expect to receive in the future? I know, for instance, I need to have $5,000 available to me in 1 year. Okay, how much should I invest today? Assuming I don't have the 5,000, I have some amount less. How much should I invest today to get that 5,000? I'm going to run a present value calculation. And essentially, at a fundamental level, it's taking what we just saw before, but instead of knowing what present value is, we know the future value, we know the calculation on how it gets to the present value. What we would need to do is take the $5,000 and divide it by 1.10. So what is the future value, present value formula? It's the same formula. It's the flip side of the same coin. We're just using algebra to rearrange the terms. If I know what future value is, I'll divide it by 1.10. If I don't know the future value, but I know present value, I just multiply the present value times 1.10. Okay? So there's no real mystery behind this. Essentially, if you understand how money grows when it's invested, then you can do a present value calculation where you discount or remove that interest down to the initial raw investment amounts. Same thing. Okay? Financial planners do the above all the time. And their goal, of course, if you're a financial planner, is to help your clients figure out, plan for retirement, put their money that they have right now into some type of investment fund to make sure it grows to that future target amount. We know the target, we just need to know how much to plan right now. So here's the thing though, that basic example we just walked through isn't typically what time value of money is limited to. Generally speaking, time value of money incorporates what's called compound interest, meaning that it's not just an investment in one period, it's an investment over several periods, either several years or several months, where we earn interest and we reinvest it. We let it ride. In gambling, we'd say, like, you earned this interest, what do you want to do with it? You want to cash out? No, we'll just let it ride. We'll reinvest it. This is where interest will earn interest. So in our first example, we saw that initial principal was 4,545. We earned interest of $455. Total amount of my portfolio at the end of 1 year is $5,000. What should we do? Let it ride. We're going to go another year. So in year 2, when we invest at the beginning of year 2, the full 5,000, you need to realize that we're investing the 45 again. That will generate 10% interest, but we're also reinvesting the interest we earned last period. That interest will earn interest. That's what compound interest is. Albert Einstein is quoted for having said 2 most powerful forces of the universe are gravity and compound interest. And the reason why is because we forego consumption and we just say, let my money work for me. Put it back in. A lot of investment options will say, what do you want to do with your returns, your dividends, your interest? Generally speaking, my dad always told me, just tell them to reinvest it. Put it right back in your portfolio. Don't touch it. Let it ride. Just keep putting it back in. You'll see that when we do this, the amount of interest in the second year is now 500. So it's grown. The amount of returns, it was $455 last year. Why is it higher this year? Because our earned interest. We allowed the money to ride. So at the end of year 2, our total portfolio value is now $5,500, which is comprised of these components: the initial investment, interest in year 1, interest in year 2. What should we do? We can cash out if we want, or we can let it ride. And so down below, I'm simply saying, let's let the interest, again, earn interest. And when we do that for year 3, we're going to earn interest of $550, and so on, and so on, and so on. We let it ride. That's compound interest. Now, what's the effect of this on the overall future value? We can see that the interest gets bigger and bigger every year, because when we start with the 45, we add the interest, the portfolio balance gets bigger simply because of the interest. We reinvest it. This is the key assumption here, is in order to have compound interest take into effect, we're making an assumption that that interest earned is not cashed out. It's just put right back into the market. So we start again, multiply by 10%. That amount gets added to the original initial investment. Then we do it again. And then we do it again. And then we do it again. We can calculate the future value doing this straightforward math on a chart, row by row by row. There is an easier way to do it, which we'll talk about in a second here. But if we do it, just draw it out, just in a logical way, in a way that makes sense to us, we know that the value of the interest is just being added to the overall investment. So if we were to connect these, you can see the interest amount is increasing over time, but it's not increasing by $45 or $50. It's actually increasing exponentially. It's not linear. If we actually were to connect these, we would see it's somewhat of a curve. That's the power of compound interest. We'll just keep adding and doubling down, doubling down. So the rate of return it may be 10%, but that's on a period by period basis. If we actually wanted to know, we said it was 1.10 times n. And over one, if we just want to know the effect of one period, we just raise it to the 1. But if we want to know what the value is over time, we have to raise it to the 5th power. So that's why it's exponential growth, because these things get multiplied by 1.1 and then 1.1 and then 1.1 every single time we reinvest it. The overall effect is exponential growth in interest. And if that interest is added to the investment, then the overall future value is growing exponentially. We know that the change is kind of like just going, we get it, put it back in, get it, put it back in, get it, put it back in. So the overall portfolio value started at 4545, ends at the 7321. But you can kind of see there's a bit of a curve here. The reason why it's curving, the reason why the future value is going up, not linearly, but exponentially at a faster rate every single period, is because it's the interest. It's the return amount that we're generating each period. That's going up more and more. So the change, yes, it's growing, it keeps getting added, but the change itself is increasing. So what do you have? It's not a linear change. In calculus, we just call that an exponential change. We get a hyperbola right there. So that's why people say invest early when you're young, because the money that you invest will generate more money. Over a longer period of time, this becomes a very steep curve. That's the power of it. But for our sake, we need to know how to determine the present value when you get multiple periods and those rates of change are exponential. So down below, one of the problems you see on your homework involves Excel, using Microsoft Excel. We can use Microsoft Excel to determine present values and future values for us. So down here, I've sort of just been kind of showing you how the formulas work. You're not going to be tested on the Excel formulas on the exam, but you will see these on the homework because alumni keep coming back to us saying these students need to know more about Excel. The Excel certification is just not sticking with them. So we need to see Excel used more in classes. Fine. So I put in some Excel problems for practice on the homework. Now, if you're in a bind, I put up on Blackboard this present value, future value calculators worksheet. So you can just use this to help you kind of get through the homework quickly. But it's also useful to help you understand what's going on too. When you open this up, I think you'll open up to the calculators tab and it'll probably be reset. If not, just click the reset button, it'll reset it back. In this case, the yellow is what you want to fill in. If you need to know, let's say, the future value of a single cash flow, a single amount, the yellow is where you want to input those amounts. So this is my spreadsheet. If you have any difficulty using it or it gets buggy on you, just email me and I'll debug it for you. The present value we said was 4545, right? And let's say we wanted to invest it for 5 years. Every year, once per year, we get interest, so compounded annually. Annual rate we said was 10%. Boom, 7319. This will calculate automatically for you in the blue what the future value is. If you switch it to present value, it just changes. Boom, down here. You input the future value amount, rate, compounding periods, years, it'll calculate present value. One of the questions was asking about what's the present value of, I believe it was for a lease on the car, where you knew that the payments were $200 every month. And it was like, on one of them, it was like a 12% implied interest rate. Payments per year were 12 because it was monthly. And number of years was like 3. So 300, it was like 36 was the total number of payments of $200. What's the present value of those payments? $6,000. So you can lease it, or if you have the $6,000, I recommend buying it. That's one way to use this spreadsheet. If you're still a little bit confused about how to interpret present value calculations, I've sort of inputted some other tabs that explain those things. So in the case where we know the future value is 7321, interest rate was 10, let's say we said once per year, 5 years, present value 4545. This also shows you, just hover your mouse over the cell, it will show you how the formula is that I'm using. You can also see it up, of course, up here at the top. But this spreadsheet right here just actually explains to you what's going on. If I invest 4545, 10% interest compounded annually, then in 5 years, the portfolio will grow to 7321. And if you change number of payments to like 12, you hit enter, it'll update these things down below. So the bottom line is I'm giving you some the Excel calculator worksheets here to help kind of get through the homework. Just realize that you're not going to see specific questions about Excel formulas on the exam. It's just good practice to know this. Mathematically, we can work through figuring out using just our calculator. We can just keep multiplying things by 1.1, then 1.1, then 1.1. You can do that. I don't like people memorizing formulas unless they've been practicing it. So it's not something I'm going to test you on. But down below, I've sort of walked you through. If you were to do the math, use a mathematical formula to calculate present value. In this case, assume it's 5,002 years, and we're still using a 10%. You can just plug in the math this way and calculate how much the present value is. But that's not something I necessarily test you on the exam. What I test you on is using present value tables. Present value tables cut through the red tape and just say, I know certain amounts, but I don't know a present value, or I don't know a future value. We're only going to be looking at present values. So in this case, I'm going to talk to you about the two present value tables you need to be aware of. The present value of a single amount, which is a lump sum, and the present value of an annuity, which we'll see here in a second. In the case of a present value of a single amount, we know, for instance, that we need $5,000 in 2 years, 2 being our N, and we're assuming a 10% compounded annual rate. The key inputs when you're using a table, present value table, is you need to know the number of periods and you need to know the interest rate that's being applied in the calculations. Here, I'm simply saying there's only one payment per year. Interest is earned at the end of the year, so once. So that's compounded annually, but for 2 years. So you got two total periods. In the present value tables, you want to go down to the row that corresponds to the number of periods, in this case 2. And then you need to say how much is the interest that we're earning on that. We say, well, it's 10% interest. So go to the column that has 10% interest, and then go down to the corresponding amount. That's the factor, a present value of a single dollar amount factor that we want to use in our calculations. The beautiful thing about this, you take the future value and you just multiply it by that factor. Boom, you're going to be done. The present value of a single amount received 2 years from now is worth $4,130. That's pretty nice, and that's what we have agreed upon in the accounting, among the accounting faculties. We don't need to give exam questions about formulas. We just need to make sure they know how to use tables. What if it's not a single amount, but what if it's like a payout? I get $2,500 at the end of year 1, $2,500 at the end of year 2. Do I prefer that? What's the present value of that? The total amount is still $5,000, but what's the present value today of that? And in this case, we want to look at a present value of an annuity. When you think annuity, think payments or regular streams of the same amount of money. So in the case of interest, usually when we pay fixed interest, we're paying a fixed amount of interest, or maybe we're receiving a fixed amount of interest. That's when we want to do annuity calculations. What's the present value of these regular streams of money, predictable amounts, predictable timing? Use the annuity table. I know I'm going to receive $2,500 year 1, $2,500 year 2. It's the same amount, regular intervals. Use the annuity table. When I look at the annuity table, and this is how you know you're at the annuity, it actually tells you at the top. It's an annuity, meaning payments. It's a fancy phrase for just saying regular payments. Do the same thing. Go down to row 2, go to the percentage column, go down. And in this case, it's 1.736. Don't worry about why it's different. I can explain that to you later if you want. But what you want to do is take the payment amount. This is the payment, the regular interval payment, and multiply it by the annuity factor. I'm going to get it, in this case, twice. So when I multiply those out, I get a present value of 4340. So we'll talk more about what that means, but essentially the key thing here is you just want to be able to use present value factors rather than just memorize formulas. So this is usually where I enter into my favorite part of the lecture. What would you rather have? Okay. Assume that we win a lawsuit and we had 2 different options to get paid out $100,000. The manufacturer says, look, I can pay you $100,000 in 5 years from today. I don't have it right now, but I can pay you in 5 years the full $100,000. And the other option is the manufacturer comes back and says, or I can pay you $20,000 each year for 5 years. Which one would you rather take? The amount that you'd rather take depends on the present value of those future streams. What is the economic value worth to me today? $20,000 sounds kind of nice for budgeting purposes, right? So a lot of people tend to say, I like the $20,000 because at least I can predict that, and it helps kind of keep me from going out and buying expensive things. Or I can receive $100,000 in 5 years, but some people say money now is better than money in the future. So which would you rather choose? Actually, I think you want to base it off of present value calculations. These are 2 different types of future values. This is an annuity. This is a lump sum. So given that we have a lump sum and annuity, let's do the present value calculations of each one of these things to determine which one is worth more today. We need to know 2 things. We need to know the number of periods. In this case, it's 5. It's one, essentially in this case, it's 1 payment per year is one of the options. So that we're going to basically say 1 payment per year times 5 years, so it's compounded annually. And the very longest period is compounded annually. Sometimes you might see compounded quarterly or monthly. At the most, what you have to worry about in this class is compounded annually or compounded semi-annually. We'll look at both those. There's 5 years, the number of periods is 5. Discount rate is 10. We're going to discount it backwards because we know the future value. We need to know the present values. The process is called discounting. Typically, what you'll see on an exam is not a table. I don't like giving present value tables on the exam. It's just too much noise. What I do is provide you with a selection of factors to choose from. You just need to know which one to use. In the case where it's a lump sum of 100,000, you want to look at the present value of $1. That's a present value of a lump sum. Ignore the annuities. I want to figure out the present value of 100,000 that I receive 5 years in the future. It's a lump sum. Next question is, which one of these do I use? Well, it depends on the number of periods. We said 5 periods at 10% per year. So the factor we're going to use in this calculation is 0.621. So 621 is the factor I'm going to use. What's the math I have to do? Well, you know what the future value is. You now know which factor you use. Plug that in. Do that math. Boom. So much easier than running Excel or using any type of mathematical calculations. The value of that $100,000 today is worth $62,100. Now, granted, you can have to sort of, if that doesn't quite make sense, think about it like this, right? If I invest $62,100 today, it would grow to become $100,000 in 5 years. It's another way of looking at it, okay? I don't know the present value. So the whole point of these calculations is to essentially discount backwards. And then a way to sort of, if it doesn't quite make sense, ask yourself, well, what if I knew this amount today? How much would it grow into? Well, that's just determining future value. It's a flip side of the same coin. Using the same formulas, you're just looking from a different perspective. So process of determining present value is the discounting. We're working backwards. We're reducing the future value, which is big, down to a smaller present value. It's always going to be, the present value is always going to be smaller. Because why? Because amounts that we know today grow over time. That's the present value of a single lump sum. In the case of $20,000 payments, what that signals to you should scream annuity. So just be careful on the exam. When you have payments, you want to use the annuity table, not the single amount table. So we're going to ignore these top ones. We're going to focus on these guys. Present value of an annuity. Question is, what's our period? What's our rate? Period is 5. Rate is 10. So we're going to use this 3.791. Down below, $20,000 is our payment. It's a future stream of money. We're going to receive it several times in the future, so we're going to use a present value annuity factor. When you multiply that out, the value today of all those streams is $75,820. So what's the value? What's the present value of $20,000 received each year for the next 5 years? Today, it's worth $75,820. Okay, so I could probably go to a J.G. Wentworth and say, I'm getting $20,000 over the next 5 years. J.G. Wentworth would say, I'll give you $75,000 right now for you to walk away. Said another way, there's just another perspective to think about this. If I invest $75,820 today and I pay myself out every year, how much would I pay myself out each single year for 5 years? $20,000. The investment portfolio would look something like this. We start off at that $75K. At the end of year one, so it would grow a little bit from interest, and then I'd pay myself out some money. I'd pay out $20,000. Then I'd let it grow again with interest, pay myself out some money, $20,000. Grow again, pay $20,000, grow again, $20,000, grow again. Final payment, $20,000. That's why it's called an annuity. A lot of insurance companies sell these types of investment contracts because people want to have a regular, consistent, predictable stream of money in their retirement beyond Social Security. So in this case, what am I really saying when I'm doing the present value calculation? I'm saying I know how much to invest today where I can pay myself out $20,000 each year for the next 5 years. And then it would go to zero after 5 years. That's what we're doing here. So which one would I rather have? I'd rather have the annuity because today, in today's dollars, that annuity is worth $75,820. The lump sum, which is preferably what the manufacturer would prefer I take, the lump sum is only worth what? That's $62,100. So which one's better? The annuity payment. That has more worth to me today than a lump sum in the future. Plus, manufacturers love to delay payouts on a lawsuit. That's when we have a situation where we have compounded annually, once per year. What if, change the facts slightly, where I say the other option is to take $10,000 every 6 months. That's called semi-annual payments, okay? Just need to be on the lookout for this on the exam. Semi-annual payments are different because the compounding happens more frequently. We're not going to have 5 periods in this case. We're going to have 6 payments. We're going to have 2 payments per year for 5 years. So the total number of payments or periods we want to focus on is 10, not 5. So given that the compounding happens every 6 months rather than every year, I can't use the same present value calculation from the previous example. If I'm going to compare apples to apples, I need to do a present value, rerun the present value calculation for the lump sum, because now it's based off of semi-annual compounding. That's how it makes it comparable. The spoiler alert, annuity is going to be higher anyways. So we need to double up the periods on the present value table, and we need to divide by 2 the interest rate, because it was 10% per 12 months, which now it's 5, which means 5% per 6 months. So this is the key thing that people tend to miss on the exam, is knowing which factor to use. It's a 5% interest rate, 10 is our number of pay periods. So if we're talking about the present value of a single amount, again, semi-annually, this is the key thing. Read this stuff carefully. Semi-annual payments, so it's a $100,000 lump sum, but it's compounded, interest is compounded semi-annually, so we need to use the 10 periods, 5%, we're going to use 0.614 as our factor. Slightly different than the previous one we saw before. We run the same numbers, 0.614, 100,000, that's still the same. The present value factor is different because the compounding is different. That's what we have to do here. So what is the present value of 100,000? Now it's 61,400. Previously, it was like 62,100. Now it's slightly lower because we're compounding. So bottom line is, how do I interpret this? If I invest $61,400 today, it would grow to $100,000 in 5 years, assuming a 10% compounded semi-annual investment. Okay. The rates when we're doing the semi-annual, the rates are all divided by 2, and the terms are multiplied by 2. And we have more payments, therefore the number of periods is double. The rate is broken down, halved, 6 months, 6 months. So take the rate and divide it by 2. The rates I give you are all based on the annual interest rate. So just make sure that for the sake of the exam, you just know what to do with the inputs if it's semi-annual. People always miss information on that. So in the case of the annuity, we're using the 10 periods of 5%. So it's 7.722. It seems a lot higher than the previous one. And the reason why is because, well, we got 10 payments at a smaller interest rate. So all you need to know is which factor to use. 7.722 is what we're going to use. The payment is $10,000 multiplied by 7.7. The value of $10,000 received every 6 months for the next 5 years. The present value of those streams is $77,000 versus the other lump sum, which was like 61,400. So taken another way, if I invest $77,000 today and if I pay myself or cash out $10,000 every 6 months, I would be able to cash, pay myself $10,000 every 6 months for 5 years, assuming a 10% interest rate, but compounded semi-annually. All those factors that I came up with, by the way, are coming from the table. So the key thing that people tend to make a mistake on is, should I be using the annuity table or just the single amount table? The other one is, what is the number of periods? Is it 5 years, or do we need to double it up? Okay, so just be aware of where I'm coming up with these things. You can Google present value tables, and they'll all be the same. There's no magic behind this stuff. Also, keep in mind that, see if I can do this real quick here. These amounts on the annuity table, they're not magical. If I do the present value for one period at 4%, I get 0.962. I take the present value and say, let's go out 2 years. What's the present value? It's 0.925. The sum of these amounts here, these factors, is what we see on the annuity table right there. So that's why annuity tables, they're not, there's nothing really magical behind them. They're basically just taking what you see in the present value of a single amount and just adding it up. So that's where we get these numbers from over here. You don't need to worry about that though. Just know which numbers to use when you're doing your present value calculations. The factors save you so much time. And so you get some practice using the tables on the homework, but on the exam, I just give you a selection. It takes too long. It's very easy to sort of like, oh, I'm going along, and accidentally go into the wrong row. So on the exam, I just give you a selection of factors to choose from to kind of cut down on the BS. Again, this is all discounting we're doing. We're taking a future amount, reducing it down to today's, what's it worth today, today's value. And the key thing about discounting is it's the underlying calculations for how we price out bonds. So present value, future value calculations, now that we've talked about those, how do those get used when it comes to our debt? Well, bonds in particular are where we have to worry about present time value of money concepts, present value calculations. Bonds are a way for us to raise money, just like issuing stock or just like going to the bank and taking out a loan. Bonds are a type of debt like loans from a bank. People often ask me, why do we need to study bonds? We can raise money with stock or we can borrow money from a bank. Why do we worry about bonds? Well, bonds are essentially debt certificates issued to the public. So we're not working with a single bank. We're basically saying, who wants to loan me money? And going out to the public. Anybody who's got $10,000 or $100,000, they want to lend us that money, we work with them directly. The cool thing about using bonds is that the rates are usually determined by us. And what the market perceives is generally a better average than what a bank simply dictates. So the key thing about banks is that banks impose what are called debt covenants. They say what we can and can't do with our borrowed money. That's not usually a good thing. Also, keep in mind, if we go bankrupt, banks come in and they start taking over control of our company. We don't really like issuing stock too much because that's just giving away ownership or control to outsiders, the public. Bonds are kind of a nice in-between. If we can issue bonds, this is a nice sort of compromise because it doesn't affect the ownership and control like issuing stock does. But it also doesn't impose very many restrictions like a loan with a bank does. Banks have an immense amount of power and control over its borrowers. Bonds payable is the account we're going to use when we issue this debt. It's very similar to notes payable. There is a principal amount, which we call face value, maturity value, or par value. The maturity date, we will usually get to set that ourselves. We also usually dictate what amount of interest we want to pay out annually or semi-annually. Interest is also known as interest rate we stamp on the bonds. It's called the coupon rate. Sometimes it's called the stated rate. Look at that more closely. But the key thing to realize here is all these things, all these terms of this borrowing arrangement are really under our control. Banks, if we go to a bank and ask them for a note, in those situations, the bank is usually the one in control of determining all these things. But on bonds, we have the power, we have control within reason, because we're going to issue these things to the public we want to make sure that, generally speaking, the public's going to want these things. So we have more control. We can still raise cash doing this. The problem is when we issue the bonds, we need to worry about how much to record on the issuance date. It's not as straightforward as you think. Excuse me. When we issue a bond, meaning that we give out bond certificates and we get cash from investors, the value that we record as the bond payable depends on the present value of the bond's 2 future cash flows. There is a lump sum cash flow related to the principal, the bond's principal. That's going to get paid back to the creditors in one lump sum in the future at the maturity date. But bonds also pay out annuity streams in the form of interest, either annually or semi-annually. So the key thing about bonds is the present value of those streams is a little bit more complicated. We've got 2 different things. That's why you need to know the time value of money concepts we just walked through. How do I determine the value of a bond? I need to take the present value of a lump sum and add it to the present value of an annuity. That determines how much cash I'm going to raise when I issue these bonds. So just like we saw before, key thing you want to start off with is figuring out the number of periods. If it's annual, the number of years is the number of periods. If it's semi-annual, just multiply the number of years times 2. The discount rate we use, this is where people get kind of confused. The discount rate we use is going to be based on the market rate, not the stated rate. The market determines whether or not they like our bonds, and the market therefore determines how much cash they're willing to lend us. So the market rate, granted there's a stated rate, we'll talk about that later, but the market rate is driving what the present value is of these future streams. The market rate also is a way of gauging market sentiment. Do they like our bonds or do they not like our bonds? But again, if we figure out the rate, we need to say, is it payments? If payments are annual, we just leave the rate as it is. If the payments are semi-annual, we want to divide the market rate by 2. Keep in mind that when we set the stated rate, usually we look at what the market rate is to determine how much we should stamp on our bonds. So there is a bit of a playing with the market to determine how much we should stamp on these things. So when I was at Washington Mutual, we did this kind of thing when we issued out bonds. Usually we got on a conference call, and everyone on the conference call was looking at a Bloomberg terminal and examining the prices or the rates on bonds that we were about to issue. So we're issuing bonds. They're similarly traded bonds on an active bond market. What are they trading at? What's the market wants, right? We may want to print everything but the rate, leave the rate to last, get it right close to the issuance date, and then determine how much to stamp on these stated rate bonds. Because if it's too low, we might not sell these things. So we want to raise $100,000 cash. That's the face value. They'll mature in 5 years. How much should we state as the coupon rate? Prior to doing that, we find out on the Bloomberg terminal, the market rate is averaging about 10%. So we go chunk, we stamp 10% on these bonds. The 10% that we print as the stated rate or the coupon rate, that 10% determines how much we pay out in cash every 6 months. 10% per year or 5% every 6 months is $5,000 for every semi-annual payment. That's about all the stated rate does for us, is figure out how much cash we have to legally pay out from these bonds. When we're doing our analysis and present value calculations, we have to say there is a stated rate, let's ignore it. We have to focus on what the market rate is. Granted, in this case, market is the same as the stated rate, but we still just want to do our present value calculations methodically. What is the present value? And granted, you have to do this for the sake of the exam. So assuming I give you the right factors, present value factors, you know the inputs, you can do the following math. Make sure you're just very careful about how to do these things. Number of periods, how many are there? Well, it's semi-annual over 5 years. So there's 10 total payments. The period is 10. The rate, granted the market, it's the market rate is 10%. Fine, it's 10% annually. What's 10% semi-annually? It's half, 5%. I give you some factors to choose from. You just need to know which ones to use. Multiply the principal. This is the principal of the face. 100,000, that's how much I've paid my investors back at the end of 5 years. Multiply that by the present value factor of a single amount. Gets me $61,000. But there's also the present value of the annuity, which is $5,000 every 6 months for 5 years, times 7.722. Present value of those is 38,609. Add those up. When we add those present values together, we get what's called the market price of the bonds. And guess what? It's $100,000. Is it magical? No, it's mechanical. Okay. Basically, we're giving the market's demanding 10% on our bonds. We stamp 10%. Therefore, these guys are going to come in and say, I like your bonds. I'll buy them at face value. I'll give you exactly what you're looking for. You want 100,000? Here's 100,000. Okay. That may not always be the case, though. Okay. Generally, we're pretty close to the stated rate, but let's assume that we stamp these things 10%, but prior to issuing our bonds, there's a market shift, drastic market shift, and the market rate now drops to 8%. What that's saying is that investors are only asking for 8% return, and we are legally obligated to pay them 10%, so they fucking love our bonds. We're going to give them 2% more than what they actually want. So this creates excessive demand for our bonds. They love 8%. Oh, I'm totally take 8%, but 10%. Oh my God, I love it. So what we'll have is usually a bidding war. We'll say like, well, you like these bonds, you're going to have to pay a little bit more, right? Think about this from a marketing perspective, right? I got something that people desperately, really, really want. Charge them a little bit more, right? Okay, this is like the intuition here. So I got these great looking bonds. I'm going to demand more than $100,000 up front. So if I go through and do my analysis, here's the key thing. I need to make sure that I change my rate to the updated market rate. In this case, it's 8% or 4% every 6 months. It's the market rate. Okay. I use the appropriate factors based on the table or whatever I give you on the exam. I do the math across, and I find out that when I add those up, I'm going to collect not $100,000. I'm going to collect $108,000. Why? Because if you got something people really like, you charge them a lot. So in this case, I'm actually getting more. The market price is much higher because I'm giving investors more percentage than they're actually demanding. So I'm going to charge a higher price. On the other hand, it could go the other way, where they say, oh man, stock market is doing really well. I don't want to invest in bonds. If I have to invest in bonds, you got to pay me like, I don't know, 12%. Well, I come and say, well, I got 10% bonds. You're like, dude, go away with that crap, right? If I'm not going to reprint these bonds, I'm going to offer them at a rate 2% less than what they want. It's going to be kind of hard to sell these things. So how do I attract people to buy things? I reduce the price. These things aren't selling, so reduce the price, right? Basic marketing concepts that applies here in bonds. So if I do my analysis, here's the key thing. The rate I'm using is 6% every 6 months. 12% is the market, okay, but divided by 2, see if it works, right? You're just going to get practices drawing this out. Use the appropriate factors associated with 10 and 6%. Do the math, add them up. What's the market price? I will get cash of not 100,000, but more like $92,000, $93,000. And the reason why is because the market wants a higher rate than 10%. So in order for me to sell these bonds, I have to just accept an amount less. I have to discount the price. Okay. Now, granted, they're going to get back $100,000 at the end of 5 years. So, they're giving me $92,000. I give that back to them plus an extra $7,400. That's an implied interest. So that's where we'll start off on Friday. So go in, make sure you read the book, work on those homework problems, use the Excel file I have up on Blackboard. If you have any questions, let me know about that. Office hours tomorrow from noon to 4 as usual. If you're free to go, if you're good to go, Otherwise, I'll open the floor up for questions. Are there any questions out there? Anybody?
Dr. Scott,
Yeah.
talking about compound interest, like what's a
Yeah.
normal compound interest rate at like a bank?
Oh, I don't know. And that's you can actually the interest rate like will actually depend on how long the borrowing period is. So um, if we're talking about compound interest, usually the rates are stated annually. So um, just basically, when it comes to compounding, you just have to figure out the monthly. Usually, take the rate that they quote you divided by 12, but the rate itself is going to be based on the length of how long the note is outstanding. So if you get into a 15-year mortgage today, I'm pretty sure it's worth like what 2.25, 2.5% annually. If you get into a 30-year mortgage, it might be upwards of like 4.5, because the longer the note is, the greater the interest rate, risk versus reward. So, but those are mortgages, and those are basically interest that you compound monthly in that case. Does that make sense?
I think so, yes. And then also you can't just like add money like midway through, right?
Well, essentially what you're doing on the compounding is you have a certain amount, right? You invest it, and then you're dumping more money, you're dumping the return into at the payment date. So you are essentially adding at a certain point in time whatever the return is to the overall investment principal. So the only thing is every time we're getting paid, it's going to be some amount bigger and then some amount bigger. So you can't quite just add a fixed amount because these amounts change based on how much you're investing at the start of each period. So it's not as simple and straightforward. We'll talk about different ways we can sort of streamline this. Does that sort of answer your question, or is that
Yes,
my obvious? Yeah. This
that
is
makes sense.
compound interest is by nature it is exponential. So it's granted there is like a theoretical line, straight line where you can just do the added, just do an addition to get you from point A to point B, but in between the values in between are not exactly what you think. So the 4545, right, is what we start with, and it was like 7321. You could sort of say, well, isn't there like, can we just straight line through that and just add a fixed amount? You could, but the amounts in between, the values in between are not linear. They're on an exponential curve. Oops.
Right. Okay.
Yeah.
And then also earlier in the on the notes
Yeah.
there you use like 3.791 and 7722, I think.
Yeah.
How'd you get those? Do you just take them from the chart that you had?
Yeah. Let me open that back up again here. I lost my place. Peter's going a little bit funny on me. Go to Yeah, so let's see here. Right when we went semi-annual, it was a bigger number, right?
Right.
Yeah, and that's the reason why. The reason why is because um, a couple things. The 3.791 is essentially getting paid out 5 times at a big percentage,
Okay.
right?
I
But
didn't
if we're
see
if we
the number on the left. That's
yeah, so essentially, if we say, well, pay me out more frequently, pay me out twice as fast, but at a smaller return. Okay.
right.
Essentially, it's the amount that we're paying out. So we were using this factor, the 3.791. We're multiplying that by 20,000, right? But if we're getting paid more frequently, where it's like 10,000, right? It's a smaller amount, just paid out more frequently. Then the factor we're using is much higher. It looks like it's almost double, basically, right?
Okay.
So take the 10,000 times 7.722, or take 20,000 multiplied by 3.791. The 20,000 is paid out 5 times, The 10,000's paid out 10 times. It's just more frequent. So roughly when we did the present value calculations, these were almost identical. I think the 10,000, the present value was like 77K, and then the 20,000 like 76K. They're pretty close, but the factors granted are very, very different looking simply because it's the frequency of how I pay out a smaller amount. Does that make a little bit more sense?
Yes. And then is it safe to assume that it's always better to take an annuity rather than a lump sum?
If the lump sum happens, well, so here's the thing, right? It's possible. In this scenario, yes, you would want to do the annuity because essentially what you can do is if you say, I want to cash this out by entering into an agreement with somebody, they say they promise to pay me 100,000 in the future or this annuity stream, that contract has a value today that I can actually go out to a third party and sell and get that cash out. So I could sit around on my butt and wait to collect $20,000. But if what happens is I can say, look, I've got this $100,000 that I have to wait, right? I have to wait 5 years to get. JG Wentworth, you probably know those commercials, basically advertises that they'll pay out right now whatever that contract is worth. And in the case where you have a structured settlement, you're getting 20, 20, 20. JG Wentworth will say, you know what, I'll go ahead and pay you $76,000 right now for those payments. So you don't have to wait. In which case you would say, well, I'd rather take the annuity because I'm going to get more from JG Wentworth if I try to cash this out. Right? I'm mad. I want cash now. Right? That's what his famous slogan is. So I could go to him and say, I got this structured annuity payment. And you say, okay, I do the calculations on this. I'll give you $76,000. I would rather take $76,000 right now than collect 20,000 over 5 freaking years. You know what I'm saying?
Right.
Granted, what's JG Wentworth going to do? He's going to sit on their butt and they just wait. So JG Wentworth will collect $100,000 cash because they have nothing but time on their hands, right? But me, it's like, man, I got bills to pay. You know, I'll take a cash out right now rather than wait around. You know what I'm saying?
So is that the whole
Yeah.
principle on their business is paying less than what settlements are worth?
Totally.
So that's how they make all their money.
Of course, yeah. Because I mean, think about it, it's a pretty good business model, right? All they do is sit around and wait. The downside is this, though, right? They're foregoing $76,000 right now. Okay, they could invest. So they could choose not to grab my annuity. They could take 76,000 if they got it, and they could invest it themselves. You know, if they invest 76,000, they can pay themselves 20,000, right? So the bottom line is usually what happens is they give you some ridiculously big discount rates to where they probably wouldn't even really give me 76. If I think it's worth if my discount rate's 10%, right? They may say, well, we'll discount it at like 15 or 20, some ungodly high number to where maybe it comes down to like say 55,000. That's what they probably say. Take it or leave it. I'll pay you 55,000 right now, right? That's really where they make their money. They discount the shit out of it. And when you're desperate enough and you see that number, I'll take it right now. In which case, JG Wentworth, they pay out 55,000. They can just sit around and collect 100, or they can just, basically every time they get the 20,000, they just invest it, grow it, stack on another 20,000, grow that again. There's just different ways that they can play this game, but the time is on their side because they have a lot of cash and essentially they're just buying contractual payment streams. But what you get if you're on the selling side is not it's going to be some seriously discounted amount. Okay. Does that make a little bit more sense?
Yeah, that makes sense.
So they make, that's how they make their money, man. Like they find people who are just desperate for cash. They got bills to pay right now. They'll take the cash. And all JG Wentworth has to do is just sit around and wait. Yeah.
And then also, so the test is on next Friday, right?
Yeah.
Is there any way I could take it on that Thursday or no?
If you have some prior commitment,
My
You could,
parents are just coming into town and they want to spend time with me.
oh, yeah. So let's talk about that then.
I know that's not like a really necessarily good reason, but
Yeah, I know, but like usually, usually they travel plans are set in advance, so that's usually pretty good enough excuse. But let's talk about that in private.
okay,
Cool.
sounds good to me.
All right. Any other
Yep.
questions?
Thank you, Dr. Scott.
No problem, sir.